My name is Jack Latham. I'm a senior associate in the employment law team and head of the hospitality and leisure sector at Myerson. The team comprises solicitors from across our various departments who all work together to meet the needs of our clients in the hospitality and leisure industries. I'm joined today by two of my colleagues. Jennifer Hartley is an associate in our property litigation team, and Freddie Timmins is a solicitor in our corporate team. As for the agenda for this morning, we will be going through issues affecting the hospitality and leisure industry from the worlds of employment law, commercial property law, and corporate law. Firstly, I will take you through some recent developments in employment law, including the new employment bill. Jennifer will then go through issues relating to turnover rent in the UK. And finally, Freddie will then go through issues relating to franchising and growth strategies. In terms of my employment law section, I'm going to go through 4 topics with you today. Changes to pay, the Allocation of Tips Act, 0 hours contracts, and the prevention of sexual harassment. So firstly, let's talk about changes to pay. So as always, coming up in April, there are going to be increases to the national minimum wage and national living wage. You will see there's quite a big jump in national minimum wage for year-olds compared to the national living wage rise. And this is because over time, the idea is to create a single adult rate of national living wage, giving all adults the right to the same minimum wage. There's also going to be increases, as always, to statutory sick pay. So currently, statutory sick pay is £116.75 per week, and that is going up to £118.75. Currently, statutory sick pay is only paid if you earn £123 per week. One of the big changes is the government is looking to remove that earnings threshold and then put in a pro rata adjustment to statutory sick pay if you earn under that amount. There's also going to be removal of the requirement for the 4-day period of incapacity. So currently, for the first 3 days of sickness for someone who only receives statutory sick pay, they wouldn't receive anything. But now that SSP is going to be payable on day 1. What this does mean for your business is usually if people ring in with a cold or a headache or something like that, they wouldn't get paid for the first 3 days, but now they will, which means you're going to have to be a bit more careful with things like disciplinary processes if you think people are potentially fraudulently taking sick pay. It is interesting that both of these changes were recommended by the Work and Pensions Committee in June 2024, prior to the election. However, the committee also realised that if there was to be an abolition of the 3-day waiting period, this would require some form of rebate, but that actually hasn't or won't be coming into force. Finally, on this section, the headline grabbing change to pay was the rise in employers' national insurance. So currently, employers' national insurance is 13.8%, but that will be going up to 15%. And this is to fill the black hole of that the previous government left behind. And it's estimated this will raise £25 billion a year by the end of the Parliament. It is worth noting that 15% rise isn't the highest it's been in recent years, and actually, as recently as 2022, there was a 15.05% employer national insurance contribution. This will be offset somewhat by a rise in employment allowance from £5,000 to £10,500, which you can use to offset national insurance liabilities, and also the government will be removing the £100,000 national insurance liability cap. In reality, this will be beneficial to micro businesses, but for any business with 6 or more employees, that increase of employer national insurance will sting despite the increase to employment allowance. I now want to go through the Employment Allocation of Tips Act 2023. So this came into force on the 1st of October 2024. It applies to all tips paid by customers on or after that date. And the Act is accompanied by a statutory code of practice setting out the criteria for a fair and transparent allocation of tips. What you should be doing as a business if you take in tips is having a written policy and keep records of how those tips are paid, and we can obviously assist with drafting any of those policies. It is interesting to note that tips are now included in the definition of wages for the purposes of an unlawful deduction of wages claim. So if you don't pay someone their tips, they can make a claim under that rule. But tips are not included in the definition of wages for the purposes of national minimum wage or national living wage. So you still have to pay those rates that we went through previously on top of those tips. In terms of tax matters, you're obviously best speaking to your accountant about this, but the basic policy on tax and PAYE is if customers give or pay tips directly to the employees, for example, they leave cash on the table, the individual employee would keep them without any involvement from the employer, and PAYE does not apply. Tax would be due on this amount, but no national insurance contributions would be due, and it is the responsibility of the individual employee to do a self-assessment for tax. However, if the tip passes through the employer, so if it's paid on a card machine or if the employer pools all tips and then distributes them, PAYE must be operated on all tips paid by an employer to an employee. As always with these things, there is the right to make a claim if you do not pay tips. And that can be for up to £5,000 plus any additional financial loss suffered by the claimant as a result of a breach. And interestingly, there is a 12-month limitation period for failure to pay tips, whereas usual claims in the Employment Tribunal, there's only a 3-month limitation period. Next, I want to talk about 0 hours contracts. So these are used heavily in the hospitality and leisure sector. In the King's Speech, the government stated that it wanted to ban exploitative 0 hours contracts, but they rode back a little bit there and the Employment Bill recognised that 0 hours contracts can suit both employers and employees due to the flexibility they offered, but they can no longer be one-sided. The way this is looking to be fixed is by offering guaranteed hours to any employee who is on a 0 hours or low hour arrangement. What that means is over a defined reference period, which is likely to be 12 weeks, if your employee on a 0 hours contract works a certain amount of hours, they will then have to be offered those hours guaranteed as a permanent change. There would then be subsequent reference periods where if further hours are offered during that initial period, it would need to be recalculated. It is worth noting there's no obligation on employees to accept those guaranteed hours because, as I said, some employees really like 0 hours arrangements. But obviously, as an employer, you would have to offer it. What effect would this have on you as an employer who uses 0 hours contracts? Well, the obvious one is if you have to pay someone or give someone a guaranteed minimum amount of hours, this may well increase your overall labour costs. Those reference periods I mentioned can also mean there is a greater administrative burden in tracking those hours and reference periods. And it might be helpful to start thinking about what your workers on 0 hours contracts worked over the last 12 weeks to see what you'd have to offer them in the future. But it is this isn't coming in until 2026, but you might just want to do that as an exercise. It's not all bad news. The end of 0 hours contracts, as it were, may create a more stable workforce because employees on 0 hours basis don't always have an obligation to accept shifts. And you might find individuals who have guaranteed hours and aren't 0 hours workers no longer see themselves as temporary workers, and therefore your turnover of staff could reduce. Again, you may face claims if you fail to provide guaranteed hours, and compensation is going to be based on what those hours should have been. It might be subject to a cap, but we're waiting to see whether that's announced in secondary legislation. There's also going to be big changes to unfair dismissal rights, and unfair dismissal is going to become a day one right or protection from unfair dismissal. But with these 0 hours contracts, if you went further and you dismissed an employee for accepting or rejecting any offer of guaranteed hours, that would be considered an automatically unfair dismissal. So, as I said, on the 26th of October 2024, there was an amendment made to the Equality Act that said that employers now have to take reasonable steps to prevent sexual harassment of their employees in the course of employment. And sexual harassment, as I was saying, is particularly tricky for the hospitality and leisure industry, where there's already a high turnover of staff. There tends to be lots of lower paid workers, and you might be much in a customer facing role. So there's a lot more chance of third party sexual harassment. The new anticipatory duty can lead to claims by workers. And there are regular claims for sexual harassment, but if you failed to take this anticipatory duty to prevent reasonable steps, then the tribunal can uplift compensation by a further 25%. So it is particularly draconian if you have found that an employee has face sexual harassment and you as an employer have not done anything to prevent that. And as I said, the Equality and Human Rights Commission takes the view that this does include sexual harassment from customers, suppliers, or third parties. So in terms of customer facing roles, you can be liable for sexual harassment potentially, or failure to prevent sexual harassment if you've not covered off how your customers may treat your employees. Whilst workers cannot bring a standalone claim for third-party sexual harassment, the EHRC can take enforcement action such as an injunction against you. But it's the Equality and Human Rights Commission 8-step guide as to what you should be doing as an employer to prevent sexual harassment in your workplace. So you should develop an anti-sexual harassment policy. You should engage with staff and perform risk assessments about your workplace sector and worker population. You should put in place reporting mechanisms and obviously not detriment anyone who does report any sexual harassment. Give training and education to managers and workers, and respond to any complaints promptly and confidentially. As I said, you need to deal with third-party harassment in terms of your suppliers and customers, and then you need to monitor and spot any trends. And as a guide, that is the 8 steps you should be taking, where if your employees still get sexually harassed in the workplace, you might well not have that 25% uplift in compensation, although it may not protect you from a claim in any event. But it is worth noting that all of that came in October 2024, but was suggested by the previous government. And the new Employment Rights Bill led by the Labour government, which was introduced around the same time the new sexual harassment reforms came in, are looking to take this even further. So as opposed to reasonable steps to prevent sexual harassment, you are now required, or you will be required, to take all reasonable steps. So it won't be an excuse to have only done 7 of the 8 EHRC steps. It will reintroduce employer liability for third-party harassment, not just in terms of sexual harassment, but for all protected characteristics. And so therefore, let's say in the hospitality and leisure industry, a customer sexually harasses one of your members of staff, perhaps in a bar setting or restaurant setting, you could face liability for third-party harassment. It will introduce powers of regulators to specify reasonable steps that you should take to prevent sexual harassment, and it will make complaints of sexual harassment public interest disclosures. What that means is, you may recall a few years ago, there was a spate of sexual harassment incidents where people signed non-disclosure agreements. What this basically means is that sexual harassment wouldn't be able to be covered by a non-disclosure agreement, and you'd still be able to disclose that in the public interest.
So if we just start from what I'll be talking about, which is the turnover rent and the challenges in the hospitality and leisure industry. So The UK hospitality and leisure market has had a tough time in recent years, which obviously everyone has heard about. And they've had to deal with a number of different challenges from a number of different factors, including business rate increases, Brexit, the COVID-19 pandemic, cost of living crisis, and greater energy costs, just to name a few. In the recent budget, it was announced that business rate relief measures for the sector weren't completely falling away, but instead that they were being reduced. Some in the sector believe that this could still, however, cause some business pressures, and this, coupled with rises in national insurance contributions, might still cause issues in the sector. However, the financial year of 26 to 27 will hopefully welcome some permanently lower business rates for retail, hospitality, and leisure properties, and that hopefully will provide some confidence in the sector. Landlords are also engaging with tenants to consider more commercial alternatives in respect of commercial property. And despite the UK leisure industry responding in different ways, what I'm going to speak to you about is more flexibility in terms of the leases around rent. Flexibility regarding alienation, use, and term length is important. But as rent is usually the tenant's largest outgoing, there is a question of whether there should be some more flexibility with regards to rent. And one way of obtaining flexibility is to have a turnover rent. So, what is a turnover rent? Firstly, I'll set over what a turnover rent isn't. So this is known as a rack rent lease, and it has a rent that represents the full open market annual value of a property, and it's essentially the market rent. A turnover rent is based on the income of the income the tenant makes from its use of that property. And there are two forms of turnover rent leases. There's a turnover top-up lease where a tenant pays a minimum base rate plus a turnover rent. And there's also a pure turnover lease where the whole rent is calculated as a percentage on the tenant's annual income. The traditional turnover based leases have provided the tenant to pay a base rent plus a top-up element calculated upon the turnover. But the growth of shorter, more flexible leases have seen an increasing use of turnover arrangements, i.e., where there's no base rent payable. For the tenant, this provides flexibility, whereas landlords might regard this as a risk, and they might see it as acceptable for short or low value lettings, where the tenant's business model is quite simple. But where the turnover rent is being negotiated, the landlord might also seek to limit their risk and incorporate more flexible landlord breaks so that the arrangement could be terminated if it's not working out. So you might ask, how do you calculate the turnover rent? And there's a number of different factors that affect the level at which the base rent and the turnover percentage are fixed. But there's essentially three different main methods for calculating the turnover rent. The first one is the straight turnover rent. And this is generally the most simple method. And it's a matter of applying the agreed percentage to the gross turnover. So if we take an example of the gross turnover being £2 million and the percentage is 2%, the turnover element of the rent would be 2 million times 2%, and that would equal 40,000. Assume the base rate was 50,000, then the total rent payable would be 90,000 on that property. For a modified turnover rent, using this method, the percentage is applied to the amount by which the gross turnover exceeds an agreed threshold, and that's often the base rent. So if we use the same figures again with the gross turnover of 2%, the percentage of 2% and the base rent is 50,000, the turnover rent would be calculated by taking 2 million minus 50,000 times 2%, and that would equal 39,000. The third method is the threshold turnover rent. And under the threshold method, the turnover element of rent is the amount of which the agreed percentage of the turnover exceeds that base rent. So on those same figures that we've just discussed, that would be £2 million times 2% minus the 50,000, which would equal 50,000. And as you can see, the landlord's intention would be that the rent figure should be at least what the open market rental value. But you can see from those examples that we've just been through, the calculation alters the rent that's payable. So what should be included in the turnover calculation? Those in the hospitality and leisure industries may generate turnover in an increasing number of ways. For example, there's traditional at-till purchases. Customers, for example, might purchase gift vouchers and then use them at different stores or restaurants. Customers might be able to purchase other goods at the shop or restaurant. There may be, for example, cooking courses or other courses that a restaurant could offer. But the underlying principle is that the calculation of the turnover should reflect sales from the premises and be properly attributable to those premises. But as you can see, that can pose a number of problems. For example, some tenants operate regional stores which serve as cost and profit centres for a number of local stores. Depending on the tenants' arrangements, there might be resistance to applying this principle in the broadest sense. So you might ask what's excluded from the turnover calculation. The idea is that turnover rent is not a profits rent, and therefore most costs are deductible. And the following that we'll go through are usual deductions. So VAT is one of them. VAT should be a neutral item, so that's usually excluded from the definition of turnover. The second one are amounts that can be reasonably and properly allowed to the customer on trade-ins. The third one would be any amounts of cash or cash refunds or credits given on return of goods or services, so long as that doesn't exceed the sale price and so long as that the sale was previously included within that turnover figure. There is sometimes a provision that goods should be returned to the premises, though that won't always be acceptable to tenants with multiple branches. In the same way, there may be a provision where credit is given back. The amount comes back into the turnover calculation once the customer uses the credit. If the credit may be used at any branch, then it's likely that this may be difficult for the tenant. And then lastly, any allowances made for defective or an unsatisfactory service, so long as that doesn't exceed the sale price and so long as the sale was previously included in the turnover figure. So now we've gone through what turnover rent is, you might ask, well, what are the pros and cons of having a turnover rent? So the traditional model of a rack rent lease it's well established and it's familiar. A rate is generally negotiated on an annual basis and it's paid usually in equal quarterly installments in advance. And if that lease is of significant length, then there may be rent review provisions to allow for the reassessment of the rent at regular intervals. And it's usually referenced to an open market rent. And the review process will be on the basis that the rent can only go up, it'll never go down. Other than that, the rent negotiated, it doesn't change. And that's the same whether the tenant is trading profitably, and regardless of what the tenant actually makes out of the property, the rent figure, it stays the same and it's known. And that model has the merit of predictability and it allows an investor a straightforward calculation on the return of its investment. But for tenants, it's really quite inflexible. And flexibility means having a fluctuating level of rent, and the mechanism for achieving that, which has found some market acceptance, is for the amount of rent to be calculated by part in reference to a turnover, which the tenant achieves from those premises. So the pros and cons for a tenant and a landlord may vary. The attractions from the tenant side are not hard to see. So in poor trading periods, there's a degree of downward adjustment of property costs to insulate the tenant from its impact. And moreover, the landlord is incentivized to help promote that property and keep it well managed, which they should do, but it's with the view of maximizing its rental income. The relationship between the landlord and tenant, you would argue, is more direct where the rents are payable on a turnover basis. The landlord's attraction is obviously less obvious since the arrangement involves assuming a part of the tenant's risk, but there are also some there is the potential to participate in profits and achieve a better rental income than they would on the open market rent. So more importantly, by offering the tenants something of a helping hand in difficult circumstances, it promotes the business sustainability, and it also reduces the risk of tenant insolvency and rental voids. And given the significant of void property costs now, this is something that's important to landlords. Landlords may also try to build in terms to protect their position, such as a landlord's break option, a success payment for the landlord if the turnover exceeds a specified threshold, and that could be in the form of a one-off payment or an uplift in the rent. Or there could also be a look-back period, which is a balancing rent due if the turnover-based element of rent has failed to reach certain levels. If there is also a lender, the landlord may have to contact their lender, and the lender might impose some financial covenants, or they may demand additional security. So that's something that the landlord would also have to take into account. So you can see the idea of turnover rent is quite a simple one, but providing the detail in the drafting of a lease in a fair way to either party requires some careful thought and negotiation. The drafting has to take into account of a variety of different practical implications that shift away from the usual fixed rent. And it also has to anticipate changes in trading circumstances. So operators in the hospitality and leisure sectors continue to demonstrate ingenuity in devising new methods of generating custom. For example, restaurants might enter into delivery arrangements with operators like Deliveroo, and that can also create some more challenges in assessing the rent on the store's turnover and how to capture it as part of a turnover calculation. So that brings me to the end of my section, and I think I'll pass you over to Freddie. And then after Freddie's finished his part, I think we'll then pick up where Jack left off.
Hello, everyone. I'm Freddie. I'm a solicitor in the corporate team at Myerson. I'm going to talk a little bit about franchising as a growth model in hospitality and leisure, and focus on why that's an attractive growth strategy. Then address some of the challenges that are common when choosing franchising as a strategy for growth, and then ways that can be managed, and then finally moving on to the resale of franchises and how that's documented from a legal perspective. So in terms of why franchising is an attractive growth strategy, one of the main reasons why it's attractive is because of scalability, and essentially it enables a business to increase its scale whilst also maintaining or enhancing its brand. So scalability can mean different things. It can mean the opportunity to expand into different territories, but also the brand enhancement point is to do with sort of perceptions of quality and reliability. So essentially, as long as you scale up and maintain quality, your brand would be enhanced in terms of brand image. People would associate your brand with quality or something similar. Franchising offers a franchisor the opportunity to expand into new territories without the cost and resource burden that would be achieved organically. It's a different model for growth, not through acquisition or establishing branches abroad, for example. Franchising is basically offering a franchisee the opportunity to license its brand, and now that can be very, very profitable. So they're some of the reasons why it's an attractive model for growth. If we could go to the next slide, please. So some of the challenges that are common, I think franchising works best where you've got a strong brand identity, and a business model that can be replicated easily. Fast food is sort of prime example of this. McDonald's, KFC, things like that, where the business model can be scaled quite easily because it's quite simple. but also having a strong brand identity. I think Travelodge is a good example. I think yeah, other hotel chains as well, Best Western, for example. It will work best. Franchising will work best where it's easy for people to understand what the brand is, and yeah, how it works. I think one of the main challenge for franchising is quality control. Obviously, a franchisor will be delegating to a franchisee, so it needs to trust the franchisee that it will carry on its business as the franchisor would to maintain the brand image. So brand dilution can be a problem where that there is a lack of control over the franchisee. There also are some timing considerations to be to be factored in, because a franchisee will typically have to undertake training before it can start trading, essentially. So they're some of the main challenges. Yeah, if we could go to the next slide. So in terms of how to manage, or how to best manage the challenges, I think this is where solicitors and we could be very helpful, because the best way to do it is to have a robust legal contract in place. Typically, that would be a franchising agreement, which essentially documents the terms on which the franchisor is licensing its brand to a franchisee. I think in terms of what that would what that agreement would entail, it would give a franchisee a period of exclusivity, which would typically be 5 years or more, and it would also detail the training and business processes. It would detail the profit share and the fee model, and any step-in rights for the franchisor in order to essentially take back the reins if a franchisor felt that it was losing control of its brand. I think in terms of the profit share and fee model, a franchisee will typically be responsible for any startup costs, and also there might be other fees. For example, marketing costs. If marketing is done centrally, then the franchisee would be expected to pay to contribute to that. Normally, you'd have 10% of turnover as a monthly fee, as set out in the franchise agreement, and then also contributions to training costs as well. If we could go to the next slide. Yeah, moving on to sort of the resale element of this. So when a franchisee wants to sell or exit, the franchisor will want to have a degree of control over this process. The franchise agreement itself will sort of set out the way in which the franchisor can control the franchisee, but the franchisor would also want to be able to control and have a degree of control over any incoming franchisee or the buyer, essentially. So that's something that I'll talk about now. So for example, in an exit scenario, the buyer would probably take a finder's fee if the franchisor was responsible for finding a suitable new franchisee, essentially, and as I say, they'd want to have control, so there'd also be an exit fee payable by the outgoing franchisee, whereby the outgoing franchisee would essentially pay up all amounts due to the franchisor, and so that's how that would work. I think it's probably important to mention goodwill here, because obviously if a franchisee has expanded into a territory, and it's got its own customer list, and client base, then that franchisee will think and believe that they've built up a significant amount of goodwill, but some of this will also be that of the franchisor as well. So I think when it comes to valuing a franchise, this is quite an important point. Now, a business would be valued by a corporate finance firm or accountants in the usual way, but it's just an interesting point to note, really. In terms of the way in which a resale would be documented, that can take different forms. It could be an asset purchase, or it could be a share purchase. In terms of how it's structured, it really depends on the network and the franchise, and how that would work. And a solicitor would typically be instructed by the franchisor, and potentially the outgoing franchisee, to oversee the process and to draft the legal documentation. And in terms of the solicitor's fees, it might be the case that the franchisor requires a franchisee to pay the solicitor's fees, or its solicitor's fees. But yeah, I think another point to note about the sort of control over the process is that a franchisor will have a right of first refusal, whereby in an exit scenario, the outgoing franchisee might be responsible for finding a buyer, but a franchisor obviously wants to protect its brand, so a franchisee might propose a new buyer, but if that franchisor doesn't like the look of the incoming franchisee, they might say, no, we'll just buy the franchise off you, rather than risk any sort of issues with maintaining the brand image. It's quite a trusting relationship, I think, and very important to choose carefully when you're or if you're considering considering franchising your brand. I think the timescales point is also important. Obviously, a sale process can take several months, and it's important to factor that in to any consideration, really, in a resale. But I think that's an overview, and happy to take any questions if anyone has any.
Thanks, Freddie. That does bring an end to the seminar today. If you do have any questions, then, as I said, our email addresses will be sent out alongside a recording of this webinar. Thank you for joining us. I hope you have a nice day, and I hope you join us at future webinars we run for the hospitality and leisure sector.